After listening to John's talk, I feel like I wanted to say amen at the end of it. And I guess I just said amen, didn't I? So there we go from that. Well, I called John an old friend of mine. I guess I would have to call the next speaker a new friend of mine because I just met him last night. We sat and had dinner together here at the Alumni Center. Matt Chiccuarelli comes to us from Commonwealth Financial Network in Waltham, Massachusetts. He has 8 years' experience in the finance industry and joined Commonwealth Financial Network in 2008. He provides marketing support to financial advisors on fixed, equity indexed, and variable annuity products to maintain direct relationships with those product teams at various insurance companies. If you're wondering why we have, sometimes people say, well, why do you have somebody talk about annuities? I'm going to ad-lib a little bit here, if you don't mind. As I look out into the world that we see, and although I was brought up by people that back in the day we had, buy term, invest the difference, and that was pretty much the mantra that people in fact used. And I think about annuity products, and we know the history of annuity products and how that industry has developed and grown. But as we look into a world where we're moving into a world where people have defined contribution retirement plans as opposed to defined benefit retirement plans, they no longer have the law of large numbers with, in fact, the people that they work with to share the risk of living too long. Now they have to find somebody to join into a group with in order to share that sort of that risk of living too long. And so I, from a theoretical perspective, which is what I get paid to think about, I actually do think that the annuity market is, in fact, one of those things that's going to be growing. As people reach retirement and they realize, I might live longer than my money, how can I prevent that from happening? Last year at the end of the session, as I'm going to say this as an advertisement to everybody here for the rest of the day, if you have ideas of things that you would like to see presented at this symposium next year, please give me the information. In fact, some of the speakers that are here this year are a result of requests or suggestions that were made to me at the end of the program last year. One of them was somebody that asked to say we ought to have somebody here to talk about annuities. So in fact, Matt Chiccuarelli, who graduated from Roger Williams University and holds his FINRA Series 6, 26, and 63 series designations. In his free time, which is, I absolutely love this, because it reminds me of when I wasn't 60. He enjoys camping, traveling, cooking, and spending time with his American Bulldog. Is it Sachi? Sachi. So please join me in welcoming Matt Chiccuarelli to our podium.
Thank you. Thank you, Rob.
Thank you.
Well, as Rob so kindly introduced me, my name is Matt Chiccuarelli. I work as a financial consultant at an independent broker-dealer firm called Commonwealth Financial Network. And I did travel all the way from Boston this afternoon to talk to you all. When you think about income in retirement, what's the first thing that comes to mind? Social Security, and usually pensions as well. But as John stated, Social Security is going to be dried up in the next 20 to 30 years. And pension plans have more or less been phased out. There are a few professions that still offer them. So that burden of providing income in retirement now lies on our shoulders, not the government's and not our employers. So the annuity is a vehicle that can help ease that burden. With an annuity, we can actually supplement our income in retirement. Now, before we get into the applications of the VA, it is often thought as a complicated investment vehicle. So let's first try to understand what a variable annuity actually is and all of its working parts. Now, before we jump into this, my compliance department required me to include this very, very important disclosure. So I'm going to give you guys all a few minutes just to read over it. Okay. There will be a test after lunch, so just make sure that that was covered. The variable annuity, what exactly is it? Well, it's a tax-deferred investment strategy that can offer additional insurance guarantees aimed at helping to meet both longevity and legacy needs. So we know that it's tax deferred, meaning that will only be taxed on the distributions that we take out. And we also know that there are going to be additional benefits that we can add on for purchase that will either supply a lifetime stream of income, longevity, or some type of death benefit that we can pass along to our heirs, legacy. There are going to be three components to every VA contract. The first one we have is going to be our chassis. The chassis is the contract itself. Now, the chassis is going to be broken up by share class, much like a mutual fund. We have B shares, A shares, L shares, C shares, I shares. There are bonus share classes as well. And each share class is going to have its own contingent deferred sales charge, or CDSC, often referred to as a surrender schedule. Basically, if you were to surrender an annuity contract within that surrender schedule, you or your client will be hit with a penalty. With each CDSC, there is going to be a mortality and expense fee as well, or an M&E fee. This is the base contract expense. And this is used to cover the administration and also the commissions paid to the financial advisors. Next up, we have the benefit riders, or those additional insurance guarantees. These aren't free. You have to pay for them as well, with a rider charge. But the important thing here to understand is the relationship between the account value and the benefit base with a VA contract. Think of it as a dual account structure. We have the account value, which is essentially the market value. It's the cash within the contract. The account value is going to fluctuate due to market performance, fees, withdrawals, and also purchase payments made into the annuity contract. Then over here we have the benefit base, which works completely independent from the account value. They're two separate values. This benefit base over here, whether we're dealing with the living benefit or a death benefit, is going to be used to calculate the amount of income given to the client, if it's a living benefit, or the amount of DB going to the heirs. It's a hypothetical value. There's no cash value in the benefit base. It's simply just a figure. Think of it as monopoly money or a shadow account. The third component is going to be the sub-accounts. This is where your investments are. This is where you're going to put your assets, and hopefully they do good. They don't always do good, but hopefully they do. Now, depending on the funds that you select, the allocation that you allotted, there will be management fees. Those will vary. Okay? So we know that there's the chassis, the benefit riders, the sub-accounts. Those three components. And we know that there are going to be charges for each. The chassis, we have the M&E fee, which is assessed against the account value. The sub-accounts, which have the management fees, which are also assessed against the account value. And then we have those rider charges. And those are going to be assessed against that benefit base, that separate value there. So let's focus on those additional insurance guarantees that I talked about. And I apologize for my Boston accent. I'll try to tone it down a bit. First of all, with the death benefit, that M&E fee that I mentioned, that's going to cover the base contract expense. And it's also going to cover that death benefit, the basic death benefit that's included in every VA contract. And this basic death benefit is going to be the greater of the account value or the adjusted purchase payments. Those purchase payments that you put in adjusted for the withdrawals that you take out. Now, there are going to be other options that you can add on for purchase, other riders that you can buy. There's a high anniversary value rider, or HAV. Basically, what this does is every year on the contract anniversary, if your account value exceeds that benefit base will jump up and lock into that new value. And then going forward, that higher amount will now be your benefit base. There's a percentage roll-up. What this states is regardless of what your investments are doing, regardless of that account value, your benefit base will be guaranteed to increase at a fixed percentage each year. Whether it's 5 or 6%, let's say, that's normal for a death benefit. So you could be underwater, but your benefit base will still be accumulating 5 or 6% each year, guaranteed. Remember, that benefit base, there's no cash value. It's only used to either pay you money or pay your heirs. Then we have an earnings enhancement, which guarantees a percentage of the earnings on top of your death benefit. So let's say you start off with $100,000. When you die, you have $100,000 of gain in that contract. If you've entered into a 30% earnings enhancement, well, 30% of $100,000 is an extra 30 grand. So that extra 30 grand will be tacked on to your death benefit amount. So instead of $200,000, $230,000 is going to be going to your heirs. Now, these additional death benefits, they don't work well with living benefits. They butt heads. They don't play nice. So you don't want to double insure. You don't want to add an additional death benefit while adding a living benefit. Because think about it. If you have a death benefit on there, you're trying to capitalize on that value growing as much as possible and then passing it along to the heirs. But if you have a living benefit, you want to take as much income out of this product as possible. So as you're taking income out from the living benefit, that death benefit portion is shrinking. And oftentimes, it's going to have a negative impact on that benefit base, a proportionate reduction. So you usually want to go with just a living benefit or just a death benefit. Lastly, you want to be wary of max issue ages. With these additional insurance guarantees on the death benefit side, the max issue age is usually 70 to 75. So ironically enough, it's just about that time when you say, hey, maybe I need a death benefit. Oftentimes, you're too old to enter into one of those. So it's something you want to plan ahead for. Next, we have the GMAB, and this is going to be our first living benefit. This is a guaranteed minimum accumulation benefit. And what this benefit's going to do is going to guarantee the return of the purchase payments through during a specified waiting period, usually around 10 years. So what investors will use this as is a safety net. They know that they can invest as aggressively as allowed in the stipulations of the rider, knowing that in 10 years, if their account's underwater by chance, the insurance company will credit them the difference. In 10 years, if their account's worth 80 grand now, they didn't take anything out, that's just due to market performance, the insurance company will give them 20 grand to make them whole again at that $100,000. Some of these actually offer step-ups as well. So if on a given anniversary, your account value, again, exceeds that benefit base, that new benefit base will lock in at that value, and then going forward, that's the amount that they're going to be guaranteeing. Granted, you're going to have to start that 10-year wait all over again to take advantage of that. But they do allow for that step-up, that increased benefit base. So how does a company hedge something like this? Well, they're going to limit your access to equities. Oftentimes, they'll diminish that access over time. So maybe in year one, you can have 90% equities, 10% fixed income. But as the life of the contract proceeds, in year 10, they may limit you to only 10% equities and force you into a 90% fixed income. Now we have our GMWB. This is going to be our first benefit geared towards producing any type of income. This is a guaranteed minimum withdrawal benefit. And what this benefit does is it guarantees the return of the purchase payments through non-lifetime distributions. And this distribution schedule is often age-banded. So the older you are, the more money you can receive. These aren't nearly going to be as popular as their lifetime counterparts, but it is going to be a much cheaper alternative to provide some type of an income guarantee. Moving along to our lifetime GMWB and our GMIB, the lifetime guaranteed minimum accumulation benefit, and also the guaranteed minimum income benefit. Both of these products are going to guarantee a lifetime stream of income for the client while accumulating some type of benefit base. By far, these are going to be the most popular type of benefit you will see on any VA contract, but they're also very expensive. On average, they're between 1 and 1.2%. And there are very important differences between both. They both offer that lifetime stream of income, but they both get there and work a little bit differently. First of all, with the lifetime GMWB, this option here is going to be a more aggressive guarantee. Whether it's with the higher roll-ups, for example, a GMIB may only give you 5 or 6%, where a lifetime GMWB may give you 7 or 8% roll-up. Remember, that roll-up is going to be on that benefit base only. Some of these lifetime GMWBs will also give you a doubling feature, which means that if you invest $100,000, if you defer for a full 10 years, at that 10th year, what they'll do is they'll guarantee that that initial purchase payment will double. You start with $100,000. In 10 years, you'll be guaranteed to have income calculated off of a $200,000 amount. And like I said before, these are also going to be age-banded withdrawals. A 75-year-old may receive 6% for life. A 55-year-old may only receive 4.5%. These are the most numerous by far. Just about every single application you can think of, there is going to be some type of lifetime GMWB that could cater towards that. But they're the most rigid, and by that I mean you have to stick to the plan. If you go into a lifetime GMWB that's catered towards deferring out 10 years, if you decide that you need income in 2 years, bad things are going to happen. Not terrible things, but that benefit isn't going to be used as it was intended for. For example, an early withdrawal can disrupt that deferral credit. If you're getting that 7% each year in that benefit base, if you take a withdrawal, you don't get that 7% for that year. Sometimes one withdrawal will make that deferral credit stop completely. Also, it often voids certain features, like that doubling effect. One withdrawal out of a VA contract that offers a doubling feature, whether it's $5,000 or $5, will void that doubling effect. So we want to use the lifetime GMWB as it is intended for. With the GMIB, yeah, sure, we're going to get some aggressive guarantees here. But the main draw with the GMIB is the flexibility it offers. For the GMIB, we have that increased flexibility. So you can start and stop withdrawals. Remember, with the lifetime GMWB, if you were meant to defer for 10 years, you want to be deferring for at least 10 years. But with the GMIB, you could say, hey, yeah, I'm going to defer for 10 years, but if I want to take some income out earlier and then defer for a few years and then take income out again, that's okay. Because every year that you defer, you're going to be getting something on that benefit base, some type of accrued deferral. You can also simultaneously take income out while growing your benefit base. If you have a client qualified assets, 70.5, and they only want to take out their RMDs, at that age it's, let's just say 3%. they can take their RMD calculations and still accrue, let's say, a 5% roll-up. So they're taking 3, and they're getting 3% on that benefit base. So the difference of that 2% is what will accrue on that income base. With a lifetime GMWB, that doesn't work like that. You take a withdrawal, you don't get anything guaranteed on that accrued benefit base. You can also postpone the decision for single or joint income. With a lifetime GMWB, you're going into that contract, remember, they're more rigid, so you're going to go into that contract paying for either a single life guarantee, or if you're married, a spousal guarantee. With the GMIB, you just purchase this product, then later on in life, you'll need to make a decision to either annuitize over a single or a joint life. Which brings us to the forced annuitization with every GMIB. This will occur at either a triggering age, usually 85 or 90 depending on the company and the product, or if you deplete that account value. If you spend your account value, and once again we have the account value and the benefit base, if we're spending that account value down to withdrawals, and we zero that out, then you're going to be annuitizing that benefit base value. So, will this result in pay cuts? Yeah, probably, depending on the age, how long you deferred for, the amount of money invested, how much money you took out, all those annuitization factors. Most likely you will result in a pay cut. And because of this, these are also thought to be as a little more complicated than their lifetime GMWB counterparts. There is no annuitization required for a lifetime GMWB. Even though it's a benefit on an annuity, and when you hear annuity, you think annuitization, there is still no annuitization required because this is a guaranteed minimum withdrawal benefit. So if you're guaranteed a 5% withdrawal amount, you're getting for life, regardless of what the account value did. You'll always get that 5% calculated off of that benefit base. So it's further important to understand the effect that these withdrawals have on the benefit bases of both the lifetime GMWB and the GMIB. So if we take a look at the lifetime GMWB first, this chart here, and hopefully you all can see it, the blue line is the benefit base. So that's that value that's going to be accruing for years that you defer. And we'll see at point of first withdrawal, our income base or benefit base plateaus at that level. And regardless of how many withdrawals we take, we're never going to get any less. It's always going to be 5% of that plateaued benefit base. The only way you could ever go down is if you take an excess withdrawal, meaning you take out more than they're allowing. If you're allowed 5% and you say, hey, I want 6, then your benefit base is going to go down. That's called an excess withdrawal. Now for the GMIB, the deferral stage is pretty much the same. Let's just say 5% each year. We're deferring, that benefit base is growing consistently. But at the income stage, when we take our first withdrawal, let's say 5%, our benefit base is still growing, remember. It's that dollar for dollar relationship. So we take 5, our benefit base goes down 5, but then we get 5 on our deferral credit. So it goes back up 5. So in that year, it's a wash. We take 5, we get 5 in the deferral, we take 5, we get 5 in the deferral, and so on, and so on, and so on. And what we can see here is that our income base is still going to plateau at that same amount. We just got there a little bit differently. What this can also illustrate is if we were using that example for a 70-year-old, one that's just taking his or her RMDs, if that orange line only went down 3% for the RMD, just that 3% withdrawal, but we're still going to get 5% on that guaranteed increase, obviously that blue line would have gone up 2%. And that would be our new plateaued value. So hopefully now we know what the VA is, the components that make up the VA. We know the different riders. We sorted through that alphabet soup, if you will. So let me ask you a question. What do lifetime GMWBs and Apples have in common? Well, there's just so many of them. For Apples, we have Granny Smith, we have Macintosh, we have Red Delicious, Golden Delicious. For lifetime GMWBs, we have ones that cater towards income now clients, income later clients. We have ones for spousal, for joint, ones for qualified money, non-qualified money. You can't make an apple pie with a Granny Smith apple. Well, you could, but it wouldn't taste like grandma's. With a lifetime GMWB, why would you purchase one that's catered towards a 10-year deferral if you're going to be taking income out now? You could, and someone might let you, but you're not going to get as much out of that product, or you may be paying too much for that product as you should. So how do we weed through that product breadth to find out exactly what we need? We have to rely on proper information gathering. So first things first, identify an objective. Is it income? Is it death? Is it both? Remember I said you really don't want to double insure, have a death benefit and a living benefit in the same contract? I lied a little bit. There are some exceptions to this, which we'll get into in a little bit. But date of birth, that's important, obviously. If it's an income case, is it income now or is it income later? And if it's an income later case, what's that deferral timeline? How long are we going to be deferring? Is it 2 or 3 years, 9 or 10 years, 15 years out? Different lifetime GMWBs, different living benefits will cater towards those specific criteria. The age at which to start withdrawals. Remember, the age-banded withdrawals. The older you are, the more you can take out. If you're an older client, let's get more money. And lastly, the miscellaneous, company ratings. Obviously, a company's integrity is an important factor. Fees. If you have a fee-conscious client or you yourself are fee-conscious, let's go with a lower-cost option. And the household name, too. Just because an insurance company doesn't have any TV spots or print ads or there's no major sports stadiums named after them, doesn't mean they don't offer a good product and doesn't mean that they're a solid company. So now that we've established that knowledge base, let's try to apply what we've learned into specific client situations. First of all, we have the income now client. And if you're dealing with an income now client or you yourself are an income now individual, meaning you want to take income out now, what are we going to be looking for? Well, there's not going to be any opportunity for deferral credits because we're not going to be deferring. We're taking income out immediately. Now, just because we're taking income out immediately and say we've purchased a benefit that's geared towards deferral, doesn't mean we're not going to pay for that feature. We don't want it. Get it out of there. Some companies will actually cater towards this situation. They'll strip off that deferral portion of the benefit, offer a benefit that only focuses on the lifetime income. Maybe they'll guarantee a 5% withdrawal for life. So with those stripped off features, they can strip down the cost, usually upwards of 50%. If it's a benefit that costs 1.2%, and they offer only the withdrawal portion, maybe they can offer that for 60 basis points. And with the lower cost, oftentimes that can lead to a higher growing income story. Think about it. If it's lower cost, there's less drag in that account, allowing your equities to perform a little bit better. There are exceptions, the GMIBs. Remember, those offer the flexibility. So you could very well be an income now client right now, but in 5 years from now, maybe you want to defer again. I have no idea where I'm going to be in 20 years. That's a long time to be married to a specific product. But what that GMIB will allow for is for you to take income out, then defer, then take income out, and defer, and always get something for those deferral years. Lastly, up here I have a single premium immediate annuity, often referred to as a SPIA, or an income annuity. This is a fixed product, and basically what it is it's your own personal pension. It's a purchase and sale between you and the insurance company. You give them $100,000, and in turn, they will give you a lifetime stream of income. Now, in doing so, you're giving up ownership of that $100,000. You're not invested in the market. You can't touch it. It's the insurance companies. But you're going to get the most bang for your buck when it comes to the income that you receive. This is an immediate annuity, so you have to take income out of this product within the first 12 months. That's where it fits into the income now situation. So we have income now. What about income later? Well, this is the exact opposite. We're going to be focusing on the deferral here. Those deferral credits. For example, does it stack? What the heck does he mean by that? Well, with stacking, let's say you have $100,000 and you're guaranteed an 8% simple increase on your money, on that benefit base. Okay? If the benefit doesn't stack, 8% of $100,000 is $8,000. So at the end of year one, you have $108,000. And then at the end of year two, you have $116,000. If it stacks, each anniversary will be looked at. So instead of just getting $8,000 each year on your benefit base, if you get an anniversary step up, that benefit base is going to move up, and then you'll get $8,000 off that higher amount. That's what stacking does. We went over that doubling effect. Compound versus simple interest. If they're going to offer you a simple interest increase, usually that's going to be a higher percentage rate, 7 or 8%. So if you're going to be deferring for only a short time frame, 5 years, let's say, let's grab that higher interest rate. That's going to have more value. But the longer you defer, the more years you don't touch that investment, the more you're going to see the value of that compounding effect, which in turn is also going to be offered at a slightly lower rate, usually 4 or 5%. So if it's income in 10, let's get a double. Why not? If they're offering it, I want it. If it's income in 15 years or longer, let's focus on those deferral credits that ratchet beyond that 10 years. A lot of companies out there will stop offering those credits after the 10th year. We don't want that. Remember, we want to get something for every year that we're deferring. Otherwise, it wasn't the correct benefit choice. Next, the younger investor. Mr. Fonz. Love that picture. So if you're dealing with a younger investor, you yourself are a younger investor looking for an annuity, what type of things are we going to be focusing on? First of all, we're going to have longer time horizons. If I'm 40 years old, I have 25 years to retirement age. So we're going to be deferring for a lot longer. Once again, let's make sure we're going to get something for that longer deferral period. We also want to avoid caps. If we're deferring for 20 years, and a company offers a 200% cap on that benefit base, chances are we're going to bust right through that. So we want to make sure that we're not going to be limited to the caps within these products. There are plenty that don't have caps. But just be aware that some do. We want the flexibility to start and stop income. Remember, who knows where we're going to be in 20 years? That's a long time to be married to an investment. A long time. Let's make sure that if we need to tap that, we can. We're not going to have any negative effects if we do so. These are retirement vehicles, so if you're younger than 59 and a half, and you take a withdrawal, hi IRS, it's a 10% penalty. Unless, of course, there's a product and a company out there that are friendly to 72T or 72Q distributions if it's qualified money. With the death benefits, we were focused on max issue ages. Obviously, with the living benefits, it's the minimum issue age. The majority of these products issue at either 45 or 50 as a young minimum issue age. If we're 35, well, how's that going to help us? We want to make sure that these products that we are looking at have a lower minimum issue age. Maybe 35, or maybe they don't even have one. Focus on those types of benefits. And then lastly, the ability to add payments. Most companies will only recognize the purchase payments that you put into this in the first year or the first 180 days to the full extent of that benefit. If we're a younger investor, chances are we're going to come across a lot more money in those 20 to 25 years that we're going to be deferring. We want to make sure that every purchase payment we put into this product will be recognized the same as the first to the full extent of this benefit. Next, we have the older investor. When dealing with the older investor, what are we focusing on this time? Well, the high age bands. Remember, they're age-banded withdrawals most of the time. So if we're older, let's get more money out. Folks, think about it. With these living benefits, it's used for longevity. The fear that you're going to outlive your asset. So initially, all the insurance company is doing is limiting you the amount of money that you can take out of your own account. It's a systematic liquidation of your retirement account. So not until you spend down your own money and then in turn dip into the insurance company's pockets for your monthly checks, you're not really seeing any benefit. You've paid all this money over these years. To what? To just get a little bit of your money out at a time? We want to take out as much as possible, spend that down, and make the insurance companies pay. So focus on the high age-banded withdrawals for an older client. Okay, hopefully I can correct myself here with the hybrid living and death benefits. These are going to be expensive, usually around 1.6%. But depending on the health of the client, the financial considerations of that client, these can very well be attractive and appealing to a specific audience. Remember when I said before that the basic death benefit was simply the greater of the account value or the adjusted purchase payments, those purchase payments that you put in, adjusted for withdrawals? In a nutshell, what these types of benefits will do is they'll guarantee the greater of the account value or the purchase payments not adjusted for withdrawals. So if you start off with $100,000 again, you're taking income out, you die after receiving 80 grand, normally your death benefit would be 20, the greater of the account value or the adjusted purchase payments. You took 80 out, you have 20 left. What these will do is allow you to take out that 80 grand, but still pass on that initial purchase payment to your beneficiaries. Sounds great, but keep in mind, you still have that dilemma. You still want to take out as much money as you can. If you do zero out that account value due to withdrawals, fees, market performance, that benefit's gone. That death benefit's gone. And that's not only the case with these hybrid products, but that's the case with any type of additional death benefit that you add on to that contract. Even the standard DB. If you don't have any account value left, you don't have any benefit base. Hands down, across the board. RMD friendly. Obviously, if you're older, you have qualified money, you're going to be taking out your RMDs. Fortunately, 99.9999% of benefits out there right now are going to be RMD friendly. But some, if you're reviewing an older contract, if you are a financial professional and one of your clients bring you one that's a dinosaur, you're looking it over, chances are it probably won't be RMD friendly. So just be aware of that. And RMD friendly, what that means is you can take out the greater of the 5% allotted withdrawal, let's say, or your calculated RMD. So if you do have a client with an older contract that's not RMD friendly, if their RMDs are calculated at 6%, but they're only allowed 5%, each year you're being hit with an excess withdrawal. Each year that benefit base is shrinking, and they're getting a less guarantee on their money. Next, the VA and SPIA blend. A SPIA is essentially a form of annuitization. So the older you are, your age is an annuity factor. The older you are, the more money that you can take. So if you can find a nice medium between a VA and a SPIA, you have the potential to provide some substantial income to the client. The married couple. Any guesses? You know something's coming, right? The Griffins. I hope you guys are enjoying my pop culture references. So when dealing with spouses, one of two things are going to happen. Either the benefit is going to cost more, but you're going to receive the same guarantee, meaning you can take out the same income as you would for a single life, or it's going to cost the same, but the insurance company is going to offer you less. It's always the case, one or the other. So all things being equal, if we're dealing with a spouse or a single life, you still want to focus on the same type of approach. If it's an older couple, well, those higher age bands, let's get more money out of that contract. Let's keep that money moving. If it's an income now type of case, let's focus on a lower cost. Why are we going to pay for a deferral? We don't want the deferral. Now, the thing here is the insurance company is always going to look at the age of the younger spouse to determine the amount of income the clients can receive. So if you have a 78-year-old husband and a 62-year-old wife, first of all, way to go. But the 78-year-old who could normally take out 6.5%, that's not going to happen. They're going to look at the age of the younger spouse, the 62-year-old who could only take out 4.5%. So even though they're married, that couple is only going to be guaranteed to receive 5.5% for life. So when you do have a large discrepancy between ages, husband, wife, wife, husband, however it may be, let's focus on a GMIB, for example, because that's 5% regardless of age. There is no age-banded withdrawal for those. Whether it's a 20-year difference or a 2-year difference, you're going to get 5%. Also, with a SPIA, This can also come into play in this type of situation. Not only can you have joint annuitants for non-qualified money with the SPIA, but you can also have joint annuitants with qualified money as well. That's a big draw for a SPIA when dealing with a married couple. So, I know that I've given you a lot to absorb. Just real quickly, I want to summarize that you really need to break down each case. That proper information gathering is so key. You need to know exactly what you're going for here. If you're the general public, have some type of an idea, have some type of vision of what you're getting at. A realistic vision, obviously, but have some idea. Know that this money that you have invested, you do not need to touch for 10 years. Or if you think that you may need it, if that's not realistic, that's okay, because there's going to be other products that will cater towards that. And then consult with a licensed professional, obviously. If you are a financial professional, know your investor. Know their situation. Have a conversation, sit down, get to know them, know their family. Survey your book of business. It's not going to do you any good learning about 30 different types of annuity contracts. Like I said, these are complicated. All the little moving parts within each rider. So if you have the majority of your book of business is couples that are already in retirement, focus on benefits that will cater towards that. Obviously, if there's someone that's younger and single, you can take some time to learn about some new products, consult with a back office staff, and also establish good relationships with external wholesalers. This is often overlooked. A good external, besides those steak dinners, they're going to know the competition. They're going to know not only what they offer as an external wholesaler, but what their competition offers. So they have something to combat with, obviously. A good external not only is going to know the competition, but they're going to want to flourish that relationship. They want that long-lasting relationship. These external folks, they jump from company to company all the time. They want to have some type of confidence that if they go to a different company, you may follow with them. Look, or at least invite them into your office. So that being said, I do have a couple of FAQs that I want to go over with you. Not because I think I need to tell you about frequently asked questions that I field, but because I don't want to be asked them. These questions I'm asked probably 3 to 5 times a week. Number 1, where is the VA market headed? I have no idea. I don't have a crystal ball. I can't tell you where it's going to be in 10, 20 years. What I can tell you is the trends that we're seeing. With the lowest interest rate environment we've seen in the past 50 years, with the 10-year Treasury at all-time lows, companies can't hedge the aggressive benefits that they've been offering. So what are they doing? They're either going to be raising the cost to hedge them or lowering the guarantees, offering less. Some companies have even stepped out of the game completely. ING and Genworth last year. John Hancock, Sun Life, back in December. The Hartford, this Friday, like in 2 days. The companies that are still offering these aggressive benefits, what they're doing is they're transitioning their requirements for their investment strategies and focusing on volatility risk managed funds. What is that? Well, basically, it's a fund selection that's going to be mandatory if you add on one of these living benefits. And the aim here is to mitigate those high highs and those low lows in the client's investment return. Cut those tails off and aim for a much more gradual approach to market performance. They don't want that volatility. That's what we're seeing more of now. Next one. What is the best living benefit? I hate this one with a passion. Hopefully now, after hearing me ramble on, we know that there's not one magical, all-encompassing annuity product that solves everybody's needs. If there was, I wouldn't be up here talking to you. I wouldn't have a job. But what we do know now is that if you have a specific client situation, that there is going to be a best product, or at least a few best products, for a married couple with only a 2-year age difference, taking income out at 75. We do know that there's going to be a best product for a 45-year-old male with qualified money looking to defer for 20 years. We do know that there's going to be a best product for a single female, age 65, taking income out now. Okay? So once again, you really need to know what you're going after. Talk to your clients. Know yourself. Establish that relationship. Just because a client tells you that they're not going to touch the money, if you know your client, they might be touching the money. What's always said isn't the case. Okay? So now, I know we've running a little bit late. I'll be around on the break, and I'll be having lunch with you guys as well. So if you have any questions now, or if you want to just talk to me one-on-one, I'll be happy to answer them. I want to thank you all for coming. It's been a pleasure.